Today we're going to talk about asset classes. Asset classes essentially are types of assets that we typically would invest in. They're pretty much five types. But before we get into the types, let's talk about what an asset is and what an asset isn't when we're talking about investments. So, from an investment standpoint, essentially we're looking for things that appreciate in value. Um, we'll get into the classes of what appreciates, but something that most people will get or understand is a house. Typically, a house would appreciate over time, right? Just historically in America, land, um, appreciates over time. And what you build on top of the land usually appreciates over time. There's some that don't, like mobile homes, for instance. They typically depreciate, but for the most part, homes that are sitting on land, homes, buildings, commercial real estate, that typically appreciates. And when we're talking about typically, we're talking about over a long span of time, right? Not in a year. Some years can go up, some years can go down, but over a long span, it'll appreciate. So that's an asset. What isn't an asset typically when we look at the major five classes? Something like a car. Let's look at a car. A car, some people will say it's an asset because you can sell it. You can sell it for cash, right? Cash is another type of asset. And that's true. The reason it's not typically looked at in the asset classes is because it depreciates over time. So it's not, unless it's a collectible item, right? But just a typical car would depreciate over time. So when we look at asset classes, we're looking at things that appreciate. So they're typically five: um, stocks, bonds, cash. And when I say cash, let's call it currency, because in the U, in some of the European countries, it's euro versus cash per se, or you can own both, right? Because there's fluctuations in those prices. But stocks, bonds, cash, commodities, and real estate. Those are your big five, if you will, of asset classes. Going in a little bit of each one. So stocks, we know we talk about all the time, right? Stocks are ownership, profit um, sharing of corporations, right? We talk about Apple stock, Google stock, Facebook stock, GE stock, Johnson Johnson stock, right? The stocks in a company that let you share profits. Um, bonds. So bonds is essentially debt. So companies, cities, municipalities, those kind of things, they take on debt. Governments, a lot of different organizations take on debt, and what they do is they'll sell you what's called a bond, and that would be a typical bond you would buy for $100 or $1,000, and they say, hey, you buy it for $1,000, and I'll give you what's called a coupon rate. So every month, every quarter, every year, whatever the duration term is, we'll pay you, you know, X percentage on the bond, whether it's 10%, 5%, 2%, whatever. And then at the end of the bond period, you get your money back. So you essentially loaning them the $100, $1,000, and then they're paying you coupon rates or interest rates, just similar to how we take out debt. If we take out debt on a car loan, we take out debt. We say, hey, bank, give me $1,000 or $10,000, and then I'll pay you, $100 increments throughout the period until you get your money back. Right, so it's structured differently, but the same concept, right? So we can buy bonds too. Typically, we don't buy bonds; we'll buy bond funds, and the fund acts that way, and then we get the appreciation of the bond fund. But anyway, the stocks, bonds, real estate. So we all know real estate, right? Homes, shopping malls, commercial offices, just overall land. Though that's real estate, and typically that appreciates. What are we missing? Stocks, bonds, real estate, cash or currency. So yen, euros, pounds, dollars, Canadian dollars, all of those are the currencies of certain countries, right? So owning currency is another asset. Does currency appreciate? Not like other assets would, but because currency is how we measure, right? Value, it's important. Meaning, when things kind of go up and down in fluctuation, currency kind of helps measure that. When we look at inflation, currency measures that. So that's why when we have currency, cash, it's always important Because if real estate drops, if stocks drops, when you have cash, you can offset that. It's an offset to the fluctuations in the market. So when things are doing really well, cash is not relative. When things are doing poorly, cash does great. So relative to the things going poorly, right? If you got a stock portfolio with $100,000 in it versus cash with $100,000, and your stock portfolio drops 50% in a given week or year or whatever, it's worth 50,000, but your cash is still worth 100,000, right? So that's what I mean when I say relative. So that's cash. So stocks, bonds, real estate, cash, commodities. So what are commodities? Commodities are things like gold, copper, corn, oil, wheat, um, tangible items that have intrinsic value in themselves, right? So gold, I mean, you could kind of make an argument that what intrinsic value does gold have, but gold still included gold, silver, platinum, those precious metals. So commodities, why are they important? Commodity prices change as well based on demand and supply of what those commodities produce. As an example, a lot of times from a commodity standpoint, crops, right? So when you're looking at orange juice or corn or wheat, um, depending on how crops do and how farmers do during harvest period determines the price of that commodity. As an example, if wheat crops are low, the supply is lower, the price of the wheat to the consumer would go up, right? So that's that supply and demand thing we talk about from a commodity standpoint. So that's the five. Why is it important that we even know about the five? Because, and this is important, when we look at the term diversification, what are we talking about? We're talking about um, hedging risk of one asset versus another. Now, most of the time when we talk about diversification, we're talking about from a stock perspective, right? Buy this kind of stock versus that kind of stock. But some research shows, and this is kind of what we talk about too. This is why when we talk about individual stocks versus baskets of stocks, why we tend to go to baskets of stocks, because when you look at the data, the majority of stock price moves together through the stock market, meaning, let's say, an electronic stock or a consumer stock versus a technology stock or a utility stock. In theory, they're four different businesses, so they should move differently. But if you look over time, they tend to trend the same way. Why? Because stocks as a whole tend to trend the same way. Now, there are going to be differences, but this is why we talk about buying things like the S&P 500, Russell 3000, because most of the time the stuff tends to trend the same way. So when we have a basket of them, we don't have to deal with the anomalies within the whole, right? So how do you diversify? Or what's one of the effective ways to diversify? The effective ways to diversify across asset classes versus just within one asset class. What does that mean? It means when you're in your 401k plan and you do a growth and income fund, you're going to have some stocks, but then you're also going to have some bond funds, right? That they're going to move somewhat differently, more differently than two different stocks would over a long period of time. Okay. What does it also mean? Cash, right? Having cash is going to move completely differently than stocks. You're not going to see appreciation of the cash over time. And actually, if you look at inflation, it actually depreciates. But when you look at it in comparison to um, when stocks are having a tough time, when bonds are having a tough time, you'll see that ebb and flow, and that cash actually will be better or do better. Um, commodities, commodities. Now, when you look at them from an ETF standpoint, you'll start to see some similarities to stock. But generally, if you think about owning oil is going to act completely differently than owning Apple stock. Completely differently, they'll act. Now, when you put it into an ETF, we talked about ETF, exchange traded funds, where they group a lot of different assets so you can trade them on a stock market. You will start to see similarities to stocks, but in theory, they should act very differently, right? So this is how we diversify. Now, what's the easiest way to do it? Stocks, bonds, cash. Those three. You really don't need more than that, but stocks, bonds, and cash will keep you diversified and kind of hedge as much risk as you can throughout the asset classes. Real estate, your home is part of that. Now, I don't like to count your home, but in theory, your home, when you purchase a home, you're in the real estate market. If you want to get into other real estates like rental properties and things like that, you'll have that diversification between stocks versus, real estate and cash and that kind of thing. Commodities, if you wanted to purchase gold and silver and platinum and oil and corn and orange juice and wheat and those kind of things, that'll keep you diversified. I recommend three, right? So you don't go crazy with this. Three asset classes will keep you diversified enough to do well. The big two are stocks and cash, right? You should always have your emergency fund, 3 to 6 years or 3 to 6 months of expenses, and that's your cash asset. That's what you have, right? And as you continue to build your um, portfolio, you can bolster that cash more, right? So A, you can do things without debt, and B, if turmoil in the markets and things come up, and you need cash to make moves and build or other investments, right? You want to move in and out of investments, you have that cash to do it, right? And then from a stock market, we always talk about the 9.6% of the equities. It's the major piece. But we also talk about in your 401k doing the growth and income um, uh, direction as well. So you can get some of that bond movement also. So you have a little bit of the bond movement, more on the equity side, and then you have to have your cash. If you want to get into real estate and commodities, you can do it as well and go across all five, but it's not necessary. The major three: stocks, bonds, and cash. And if you want to get into real estate and commodities, you can too. But wanted to hit the 5 asset classes for you guys. NormBakerJr.com. Hit me if you got questions. You want to work together on some of this stuff. You want to get some one-on-one time. We can talk about it. So talk to you guys later. Peace.